FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. Today is December 2nd, 2019. Hope you all had a great Thanksgiving. I'm still trying to speak after being totally bloated after a delicious meal that my friend Carol cooked. It was amazing. The only thing, it was gluten-free, and that just bothers me, but she made up for it. Really good dinner. So anyway, with that out of the way, hey, is the U.S. hegemony in the world economic system coming to an end? And is real estate your out to avoid the eventual collapse of the currency and the economy and the global economic order? I don't know the answers to those questions, but my next guest will help shed some light, some insight into that. So what's your opinion? Email us, kl@kerrylutz.com, or comment on the YouTube channel, on our website at financialsurvivalnetwork.com. Next person you're about to hear from, you're probably familiar with him if you've been on YouTube at all. Name is George Gammon, Gammon, and that's the name of his YouTube channel. George, you are an entrepreneur, investor, and somewhat of a philosopher. You're into the macro scene, and we are thrilled to have you on the show. I just got done listening to your review of Peter Schiff's most recent book, I guess about the coming crash. I don't remember the exact title, and basically makes a compelling argument for the bankruptcy of the United States and that we're basically bankrupt already. What's your thoughts?
Yeah, I agree with him. If you just look at the numbers, and if you define insolvent the way it's supposed to be defined, and if you look at the the government's balance sheet, and then look at all of the liabilities that they have off balance sheet, then by definition, they're completely insolvent. So it's not necessarily even my opinion. It's just a matter of math. Yeah.
Well, I always use this saying. My grandfather, who had an 8th grade education, still managed to become a very successful businessman at the height of the Depression. And he always said, when you're paying interest on interest, you've got a problem. And that's what the U.S. is doing, right?
Yeah, I think he's right. That's right. And a lot of people say, and rightfully so, that the Fed or the government can just print the money, so they're never, ever insolvent. And that may be true, but that's still a default technically, because you're not being paid back with dollars that purchase as much as the dollars you lent the government.
Mm-hmm. And that is a problem for all of us. You only have to look back and see dollars trading for 97% less than it did when the Federal Reserve was created. And right. I'm going to use a quote from your Twitter feed here. So the Fed, a group that raises and lowers interest rates, is supposed to create 2% inflation, full employment, conquer climate change, fix the government's addiction to spending, and eradicate poverty. And if I might add, and that's all supposed to work out okay?
Yeah, exactly. What could go wrong?
Yeah, right. So the Fed's in a box. The only good thing is, and as a real estate person, I think you'll appreciate this analogy, the U.S. dollar is the Taj Mahal of Baltimore.
Of Baltimore?
Yes.
Yeah. Yeah.
Meaning all... the U.S. is the worst currency in the world, except for all the others.
Yeah, the cleanest dirty shirt, right?
All of that. So that is something that maybe we have going for us. The military-industrial complex, which has got us, enough times to destroy the world over, many, many times. But one thing Peter Schiff points to, and you point to also, it's not just the federal government that's bust. It's the states that are bust. Even the best managed, so-called best managed states, of which I live in one, Florida or Texas, still have like major gobs of debt and pension obligations. Actually, Florida's only, I think, 6 or 8 billion behind on its pension plan from being fully funded, which for a budget now, I think it's up to 60, 70 billion a year. probably not that big a deal. They're just a couple of big scores on the derivative market away from being fully funded, right?
Yeah, there you go. Exactly. Just go to the blackjack table, put down on roulette, whatever, and just let's make it happen. Let's fund that pension.
Yeah, keep doubling. It's called the gambler's fallacy, that you could keep losing, but eventually you have to win, and you double down every time. It's called the martingale system, exactly. Right? And guess what? Eventually you wind up broke if you follow that system.
Yeah, because you can't beat the house, because the house has more money and more staying power than you do. Mm-hmm. I went a long time ago. I got into counting cards and blackjack and all that stuff. So that actually helped me a lot in business, and it's helped me a lot in investing as well.
Yeah, well, it's always pays when you sit down at the table to have an advantage. And if you can't have an advantage, don't sit down at the table, right?
That's right. You got to have an edge.
And that's one thing that, as a small investor that isn't tied into algorithms, whether it's real estate or even watching stocks on the market, investing in value stocks or perhaps mining stocks, you can have an advantage over the algorithms because they got to be in and out and they can't take a longer term perspective. Peter Lynch was a big proponent of that, the walk down Main Street or the walk down the mall. Unfortunately, when Peter Lynch wrote that book, there weren't ghost malls by the hundreds littering the landscape of America, right?
Yeah, that's right. You got it.
So there's still winners, there's still losers, but your whole focus, if I might, on your site, on your Twitter feed, on your YouTube channel is how to become a winner or how to stay a winner, even if others or the vast majority of people around us are losing.
Yeah, that's very well put. Yeah, and going back to your earlier point about having an edge, I just wanted to mention that is one of the things that's so great about real estate, because the average investor can have a huge edge there because the market is so inefficient. And if you look at like a Forex market or something, it's very efficient. It's tough to get a spread there. But if you go into real estate, who knows why someone is selling? Who knows why someone is buying? They might just like you, give you a better price. They might need liquidity super fast because they have a dire emergency. There's so much inefficiencies. There's so much of a spread that if you know what you're doing, you can have a huge edge.
And you get to play with the house's money. I mean, You mentioned you've invested in South America. I don't know how developed the mortgage markets are down there compared to the U.S. So you have to go for other alternative funding there or cash financing, which, the good thing about that, when you think about it, if there was no mortgage market in the United States, how much would that $500,000 house could it really sell for? Assuming you had to put 20% down, maybe it could sell for 35% of what the asking price is for today. You'd have to save that money and it would be a lot more difficult. So there's pluses and minuses to it, but the availability of debt always drives up the price in the market, regardless what it is, whether it's college education, a perfect example of a bubble, and unsustainable debt that cannot be paid back.
Yeah, it's a great point too about the interest rates in the housing market, and that if interest rates went to, let's just say they normalize, people forget, but a normal historical rate for mortgages is what, maybe 8-9%? Something like that. So you can just imagine how that would decimate the market. But a lot of bulls, housing bulls that, email me or comment on my YouTube channel, they'll say, well, housing prices have gone up for the last 10 years, last 20 years, and it's going to continue to go up. And just because it's gone up, and they don't really give me any hard, concrete reasons or catalysts as to why, but they'll admit that interest rates are important. And if interest rates went to, 5 or 6 or 7 or 8, that would affect the housing market. Well, my question for them is, well, what is that interest rate catalyst that moves the market higher? How are prices in California, as an example, home prices, when you've got such a delta between the price of the home and the average household income? What type of interest rate policy is going to drive that higher? How are you going to get another double, or how is it going to appreciate 30% from where it is right now, when the discrepancy between the current price and not only the income, but the historic price adjusted for inflation is obscene. It's at levels, if not higher than 2006. So my point is that in order to get another double or to have that price appreciation from the interest rates, we're already at almost zero. If they hit the lower bound, then they can try to do as much quantitative easing. Or I read an article today about managing the yield curve, not necessarily through quantitative easing, but more targeting rates as opposed to a lump sum amount with QE. And, but how much lower can mortgage rates go at a certain, there's not that much wiggle room. So long story short, there's really no catalyst that I see for home prices increasing substantially, especially in markets like California, Washington, Oregon, et cetera.
Yeah. Well, that's a really great question. I think the Fed's kind of outliving its usefulness on this score. But question is, so because everything is rate dependent and everything is debt, we don't have, the currency itself is a debt-based currency. Every dollar in existence is borrowed into existence. So we've got this, the world lives on credit. It doesn't live on assets. And unfortunately, credit's one of those things that, it's like crack. It's like any other addictive drug. It's like OxyContin or something, hillbilly heroin. And we become addicted to it, can't live without it. And then when we need that next hit the most, that's when the supply just dries up. Now, since interest rates were deregulated back, in the 80s, usury laws were done away with. We've never really had these credit shortages at all. But do you foresee a time when we're going to have a credit shortage?
FSN Radio. It's all about what's next.
Today's show is brought to you by U.S. Gold Corp. U.S. Gold Corp is a U.S.-focused gold exploration and development company advancing high-potential projects in Wyoming and Nevada. U.S. Gold Corp has consolidated a district on Nevada's productive Cortex Trend and is advancing the Copper King project towards production in Wyoming, led by a team of prolific company builders and renowned explorers, including Dave Mathewson, who is directly responsible for several major Nevada gold discoveries. U.S. Gold Corp is well-capitalized and has an extremely tight share structure with less than 20 million shares outstanding and trades on the NASDAQ, a major exchange under the ticker symbol USAU. To learn more, go to usgoldcorp.gold. That's usgoldcorp.gold.
The Financial Survival Network. It's all about what's next.
Absolutely, because if you look at a chart, interest rates are cyclical. So we've been in an interest rate down market since 1981. And they normally run in cycles of 20 to 30 years. Well, we've gone way longer than that. So at some point in time, if the history of the United States tells us anything, we will go back into an interest rate cycle that increases for 20 to 30 years. So to your point, with all that debt outstanding, and to Schiff's point, not only at the federal level, but the state level and the consumer level, how does that look, or how does that play out if we go into an interest rate cycle that goes up for the next 20 to 30 years?
Mm-hmm. Yeah, that will be a complete disaster in every market. Hey, how much would a new Mercedes sell for if there was no credit to finance the purchase, right?
Well, all I have to do is look at housing prices in markets where there is no credit. And that tells you right there. And another thing I wanted to mention, that in Schiff's book, he makes a fantastic point that obviously we had the subprime, or one of the catalysts to the subprime meltdown was the fact that you had all these people out there that could not afford their loans if the interest rates adjust, because they had these adjustable rate mortgages. Mm-hmm. But Schiff's point is that now the federal government is the largest subprime borrower, if you want to use that analogy, in all of human history. And people forget that, we've got 23 trillion in debt, but a lot of that debt is an adjustable rate mortgage. It's not like they've got that, it's not like they've got a 30-year fixed rate mortgage on that 23 trillion. That stuff rolls over. And if it rolls over 2 years, 3 years, 5 years, I think the average time or the average maturity on their balance sheet right now or on their debt is about 5 years. Well, what happens when we go into that interest rate cycle that starts where rates start going back up and the Fed has to roll that debt over just like the homeowners, all the subprime borrowers did back in 2007 and 2008?
Mm-hmm. That's a good question. Hey, and so you're implying that like central banks are becoming subprime borrowers or the ultimate subprime borrowers out there?
The governments, yeah, and the central banks. And there's a limit on, technically there's no limit on how much the Fed or a central bank can print. But there is. If you think about it, if we get inflation, that has the ultimate power in the market. And no matter how powerful the Fed is, they have to submit to inflation. Because whenever looking at a problem, well, if the market crashes or if the economy goes into recession, well, the answer is always, well, the Fed can print more money. Well, the Fed can always print more money. The Fed can print money to buy stocks. The Fed can print money to keep interest rates low. The Fed can do this. The Fed can do this. If we get inflation, the Fed is impotent. They're done. They're completely done. All those tools are gone. The only thing that they can do is sit and watch or Volcker style jack interest rates, which completely decimates everything and makes matters worse. Now, I would argue that we need that. And that's the cure. That's the only way that we're going to hit the reset button. And I think Schiff would argue that as well. But that's what no one seems to be talking about right now, because as human beings, we have this recency bias, and we haven't had to deal with inflation since the 1970s. People forget that we had Carter bonds. And people, that's completely out of sight, out of mind. It's just, they don't even like to acknowledge that. But my point is, with that recency bias, people have gotten into the belief that we just can't have inflation. It's impossible. We're never going to get it. And there you get MMT. That's the whole premise of MMT, that we're just too worried about inflation. It's never going to happen. So anything that we need, why don't we just print the money for?
So the Federal Reserve and the federal government become a giant wish fulfillment machine and just dream up to your heart's content. You know, I think, hey, remember in the 30s or during Herbert Hoover, prior to the Great Depression, it was 2 cars in every garage and a chicken in every pot. So I think that everyone should have a fleet of Mercedes. I personally lean towards a GS 700 for my getting around the continent or the globe vehicle. And I think the Federal Reserve should just print me up the money, helicopter money, so I can do it.
Why not?
What could
we
go
don't
wrong?
Worry about inflation.
Yeah. Yeah, because what the MMT omits or neglects to analyze, a major factor is that the value of money is tied to exactly what it can actually purchase. And you can fake stuff out. And they could say, well, we haven't had inflation for the past 30 years since Reagan. But that is a lie, because the inflation has hit certain sectors like homes, like real estate, like college, like the stock market, like collectible artworks. All of these things, like collectible wristwatches, well, these things have gone up hundreds fold. And that is the definition of inflation. Well, the real definition to a monetarist is, or a Miesian Austrian economics, is inflation isn't a rise in prices. Inflation is a rise in the money supply. But they found all these clever ways to hide and distort it, like sweeping accounts out of checking accounts into CDs overnight and then going back. So that comes out of the money supply. The fact is, the acceleration rate of new creation of money has declined over the years, but at the same time, the the velocity, I should say. But at the same time, what's happened is the supply of money, it's grown astronomically. So, the big question is, when is all this going to happen, and where can I find a bunker that's going to work?
Yeah. Well, I also want to point out, I did a video the other day on the CPI being just a complete scam. and what I meant by that is that if you take the way that the government measured inflation in the 1970s and applied it to today, our inflation rate would be north of 7 or 8%. If you took the way that the government measures inflation today and took it back to the 70s, well, the inflation rate would have been maybe 4 or 5%. So you can only have one choice. It cannot be that the inflation rate in the 70s was correct and the inflation rate today is correct. That's impossible. Those two thoughts can't coexist. So either the 1970s was a complete boom time. I mean, that would have been the biggest amount of real GDP growth that we ever had in the history of the United States, or the inflation rate today is a lot higher than people think. Those are your only two choices. And from living through the 70s, as a kid, but living through the 70s and going back and reading history, I would guess that the 1970s probably wasn't our greatest decade of real GDP growth.
Mm-hmm. Yep. In the 70s, the 60s really was far greater GDP growth than the 70s, and the 50s were far greater than that. So if all the numbers are cooked, and obviously the unemployment rate is also cooked, the one thing that is encouraging on the unemployment front is the fact that new claims for unemployment benefits are at generational lows. So, but we're working off of a diminished workforce, obviously. So all these numbers are cooked, and what it really points to is a declining standard of living over the past generation and a half that has been masked by cheap imported goods and excessively easy credit. And once those two things run out, then it's hallelujah time.
Yeah, and I'd like to point out that if you look at a chart of real wage growth for the middle class, you'll see that it's been, pretty consistent, or maybe even a little bit lower. But that's measuring inflation the way the government measures it now. If they measured it the way that they measured it in the 1970s, the CPI would be much higher. And if you layered that CPI over the wages, then real wage growth would have declined dramatically in the last 20 years.
And it has. And it's been made up for by ability to finance. And let's not also forget that the quality of the jobs available in the job market to unskilled people who were formerly solidly ensconced in the middle class has also diminished greatly. The steel mills, there aren't that many jobs, and that's partly due to outsourcing them, but also due to automation, which has reduced the need for the number of manufacturing workers. And a manufacturing job was, and still is, the pathway to solid middle class standard of living. But all that's become more complicated now.
Yeah, that's right.
All right. So we didn't get as much into real estate investing as I would have preferred, but I am definitely going to have you on again. Just tell our FSN members out there where they can find you, where the best places to read your work, watch your YouTubes, etc.
Yeah, just YouTube or Twitter at George, typical spelling, Gammon, Gammon.
All right. And we will have a link to your YouTube channel. You don't have a regular website, I take it?
I do, but I spend so much time on YouTube that's really the best place. If you want to reach out directly, Twitter is the best way to do that.
Okay, excellent. So, we'll have the links there in the show notes of this interview. Really appreciate you coming on. Hey, what do you think about what George had to say? And what do you think about the coming meeting of the United States destiny after decades of profligate spending and really dilution of the country's productive citizenry base. Where do you think we're heading? The email address, kl@kerrylutz.com. The Twitter feed's at Kerry Lutz. Facebook page, Financial Survival Network. And visit our website, financialsurvivalnetwork.com. Sign up for a newsletter. George, been a real pleasure and honor speaking with you. We'll put you on our regular roster of guests.
Sounds great. I look forward to it.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.